位泛宇集团的旧与新知老朋友、新朋友，大家好！非常欢迎您拨时间参加我们今天的线上讲座。照惯例，在我们的讲座开始之前，先为您介绍我们的泛宇集团。泛宇集团是在胡正国总裁集结过去30多年的经验之下，归纳了4大板块，不外乎在财经处理上您会遇到的问题，包括了保险、投资跟退休规划、房屋贷款，以及最重要的是税务。税务可谓是所有的财富规划、财务管理的基础。泛宇集团也在2015年胡总裁的带领之下，集结了旗下的公司，完整的开展了一站式服务的金融平台。我们有泛亚财务保险、泛宇资产管理公司、泛宇商用保险、健康保险、泛宇地产以及泛宇税务，还有泛宇贷款以及格林证券公司。泛宇集团人寿保险跟年金规划更在过去30多年创下良好的佳绩以及口碑。我们能够帮我们的客人或是公司或是财团在寿险年金产品上做不同的组合搭配，也有多样化的产品组合，能够为您的公司、为您的企业做风险管理，同时还有免税退休规划的服务。泛宇集团也推出了投资退休规划的服务，我们有非常专业的家族办公室 Wealth Management 的团队，以及律师或是相关的税务等等需要评估的规划团队，能够为高资产的客户、金字塔中端、尖端的客户带来您最需要的切身打造服务，并且绝对可以保护您的隐秘性。我们都知道现在是贷款的好时机，泛宇贷款也为我们的客人推出了最好的方案。同时我们还有泛宇好易贷私人借贷的方案，一样可以按照您的需求，按照您的规划，为您做出最需要最切合的服务。我们在2021年也推出了最新的泛宇税务，能够为自雇主、小型企业主推出了最优惠的税务方案，帮您解决 payroll、个人税、公司税到底应不应该成立公司等等所有恼人的问题，并且能够帮您就着您所需要的公司整体财务规划、省税方案做出最好的量身打造。综合以上所为您介绍的泛宇集团，您应该知道集结了过去30多年在胡总裁带领之下的经验。现在在全美我们有超过5000位以上的独立经纪人，超过180位以上的全职员工，可以完整的为您在金融的一站式服务平台上推出最好的帮助。在美国遍布10大州，我们有超过27间据点的办公室，能够为大家带来服务。同时总裁也获得了洛杉矶星岛日报颁发的最佳杰出美国华人企业主奖，可谓真的是取之于社会，回馈于社会。在2020年疫情爆发的时候，我们的集团快速的应对对接，成立了自己的自媒体，开创了我们的财经节目泛宇财经报，每一周固定的为您更新股市动向、生活话题、市场更新、财富管理以及投资策略。欢迎订阅、按赞我们的 YouTube 泛宇财经报。今天非常谢谢您拨空参加我们的讲座，接下来就把宝贵的时间交给今天讲座的主讲人。
各位线上的朋友们，大家好，很高兴再一次的到我们线上的专家研讨会。今天我们因为有guest speaker， 所以呢，我们现在要切换到英语的模式。那我们前面的45分钟左右的时间，我们会有2位English speaker only 的 guest speaker， alright， 给我们一些分享。So let's switch to the English mood, alright. So I'm Jerry Shen, and welcome everyone to tonight's Zoom meeting. So tonight's session will open to 2 chapters. And the first chapter we're talking about from JP Morgan, the guide to the markets. And we're very honored to have 2 guest speakers tonight. The first one is Ben Barchey from Prudential Annuities. Prudential is a great company that partnership with our firm too. It's a great provider that we honor to work together with. And also we thank you very much for Prudential to invite Brian, who is from JP Morgan, to join us tonight to give us an overview about the market. So without further ado, I would like to give the mic to Ben first. Ben, are you there?
Hi, Jerry. Thank you. Thank you so much for that great introduction. And that was a great video. That was very nice. So yes, good evening, everyone. As Jerry mentioned, my name is Ben Barchey. I'm with Prudential Annuities. And you know, I think what Jerry wanted me to do was just kind of quickly talk a little bit about, you know, Prudential as a company. And I think one of the best things that we can really do is just really act as a resource of a sounding board to the industry. And also, I think, bring together, you know, the insurance world, but also the investment world. And I think that's why we've done so well, you know, over the past, call it, you know, really 30 years in terms of that space in the annuity space. So that's where Brian and JP Morgan come in. But I'm just going to quickly share my screen and just give you a couple tidbits on Pru, just to make sure you guys feel good about us. And also too, if you start using us, kind of some of the talking points a lot of our you know, advisors use. So let me pop open my screen. So this is just a nice piece on Pru. I'm just going to go through a couple of things. I think number one, you know, we're 145 years old, and a lot of people look to us for just you know, kind of not only as a resource, but definitely an investment vehicle. And like I said, we're very well known in the insurance world. And if you think about it, right, I think a lot of people come to us because of our rankings and our scores. When you think about Prudential, you not only do you have a 145-year-old company, but you also have one of the highest rated companies in the world. A Comdex, for those that know insurance, is probably the most important rating you can get. It's out of 1 out of 100. It's literally a scale. It has a lot of different attributes on that ranking, but we take a lot of pride in that. And that's really a direct score on the actual health of Prudential, as they call it, general account. The general account is really where all the guarantees and all of the you know, things that we say we can do come from. So we definitely take a lot of pride in that. And then again, you know, not only are we the #1 insurance carrier in the world, but also we own a little company called PGIM, P-G-I-M. And, you know, they're also going to be very well known in the asset management world. They're not going to be insurance, but, you know, I think that you can definitely go to, you know, a lot of public forums, but I like just going to our public website. And this isn't the insurance side, but this is our asset management side. It's kind of similar to JP Morgan, but at the end of the day, when you're doing business with Prudential Annuities, you're getting access to not only the great insurance carrier, but also a great asset manager. You know, we're trailing JP Morgan for sure, but it's great to kind of see that you get that support plus pulling together a ton of great companies like JP Morgan. So, you know, I know Jerry kind of wanted me just to kind of touch on that, but what I really wanted to do was really introduce our next speaker, Brian Shea with JP Morgan. He's my counterpart out here. He does a lot of great work. He's a great representative of JP Morgan, and what he's going to do is really present their very famous Guide to the Markets presentation. And I don't know, Brian, it's all yours.
Great, thanks so much, Ben. We all are still adjusting to this new norm, right? This work from home type of environment, whether it be technology problems or what have you. We're all faced with a lot of the same ones. So hopefully, I'm not going to be running into the same thing here. So let's see. We'll share my screen for you now. And keep me honest, Jerry, Ben. Can you see my screen okay over there?
Yes, perfect.
Great, thanks so much. And I'm going to stick with the PDF version. It just seems to be a little bit more efficient than the PowerPoint, and causes less issues. But first and foremost, thank you, all of you. Thank you, Ben. Thank you, Jerry, for having me on. Always a pleasure to speak with you guys. And really, at the end of the day, with these types of conversations, we want to make sure that any of the content that we bring is going to be valuable, right? It's going to add value to your business. It's going to add value to the conversations that you're having with your clients, and really trying to paint a picture in terms of determining kind of the noise from the important, right? We all watch the news, and whether it be CNBC or Fox or CNN, there's a variety of different things out there, but I think what's truly important is to find the messaging and why the why and why that's important to your portfolios and why you need your advisors to help you build those out to be a bit more long-term focused, right? Maybe bring the emotion out of investing a little bit and think more about the long term, more about time in the market as opposed to trying to time the market. As always, as mentioned, Ben had mentioned before, Prudential and JP Morgan have a long-standing relationship, a variety of different products on their platform. But I think really the baseline and the importance of it is just the partnership. Right? We've worked together for a long time, and it's definitely been two large firms that truly understand the meaning of bringing value to your clients, and that's what we were hoping to do today. With the guide to the markets. Outside of this, before we kind of hop in, we do have a variety of different materials that we can use, whether it's the guide to the markets, guide to retirement, but also white papers that help you to kind of decipher kind of what's going on and maybe why that's important as a nice little takeaway and something that you can read kind of after hours there. But with the guide to the markets, it is our cornerstone resource here. For those of you who are unaware of it, it is distributed to over 20,000 advisors across the globe. We do update that daily, and it's something that we hope to once again allow you to have a much more impactful conversation. And when we kind of went about thinking about how to build this out, we did want to make sure that this is not going to be something that you hand a book to someone at 75 pages and you say, here you go. So what we did was we actually made it customizable. So now with COVID obviously going on, we're all much more digital. You can access this in a couple different ways. First off would be jpmorganfunds.com. You'll click on our Insights tab and you can download a copy there, a daily version. But once again, you can also customize that. And if you have an app, you can go to JP Morgan or the traditional app store on your iPad. You can download JP Morgan Insights. So a couple different ways to access the information, but once again, completely end client approved, completely customizable, and something that we hope to help you kind of tune out some of the noise and focus on what's truly important. So when we dive into the guide, we're going to just take a quick update on COVID and the economy and kind of what we've seen so far from the recovery. We'll kind of share some of our thoughts around the equity markets, talk about fixed income and some of the challenges maybe that we've all been presented with given the ultra low rate environment that we're in. We'll touch upon international markets and some opportunities there, and then kind of finish up with some investing principles, right? What we can use with our end clients and how we can really take some of the information that we see throughout the economy and throughout equities and fixed income and really make that applicable to our portfolios and how we position different products in different ways to build out that all-weather type of investment vehicle. And hopefully something that's a bit actionable for everyone as well. So the first slide is actually not from our guide to the markets. It's actually from our guide to retirement. It's the retirement equation. And I think as we kind of look at the situation we're in right now, it's a good opportunity to kind of reset our expectations. Right? Think about the conversations that we had years ago when we first sat down with our advisor. Right? What are our actual goals? So I think when you kind of focus on and kind of see what we talk about on a day-to-day basis, a lot of it tends to be things that are completely out of our control. Right? What the market's doing, what policy and what the administration is doing, what taxation policies are like, and things of that nature. Things that we really have virtually no control over tend to be the ones that we obsess about most. And then there's things that we have some control over, right? Our longevity. So are we taking care of ourselves? What our employment status looks like, how long we plan on working, what our plan looks like for that, and then things that we have complete control over. So what our asset allocation mix looks like, how much we're saving versus how much we're spending, right? So resetting that expectation and just kind of having that conversation, whether it be with our clients or with ourselves, right, about why and kind of how we should be looking at things moving forward. Sorry about that. So if we kind of zoom out the lens a little bit and just think about 2020 and look at COVID-19, obviously a huge impact on the economy, socially, economically, financially, for a variety of different reasons. And this really just kind of gives us an update in terms of what we're seeing in terms of a 7-day moving average as of yesterday, fatalities on the right-hand side in a dark gray line, as well as confirmed cases. which is in that lighter blue line. But as we see, right, we had our huge spike up in the beginning, right, with the fatalities and with confirmed cases. We had a bit of a lull, and then at the end of last year, we saw that huge surge, that second or third wave possibly towards the end of the year, right? But what we've now seen, as we're starting to see, whether it be Pfizer, Moderna, and now Johnson & Johnson, those vaccines starting to be distributed, we're starting to vaccinate the larger portion of the population. I know here in Arizona, we're just over 20% now, and across the globe, we're starting to see things develop and things start to shift a little bit more towards the ability to start to open back up again, right? And so when we think about how that is and kind of how that actually affected the economy, we're really looking at the left-hand side of the page, right? The economic growth and the composition of GDP, but focusing on kind of what we saw from a growth perspective on the left-hand side was that trend growth that we saw, about 2.5%. Right? We were chugging along right during the past administration, and what we saw towards the end there was COVID-19. We saw that the sell-off happened almost immediately. We essentially had a really strong economy that was turned off like a light switch, right? And what we saw was the inability for things to grow and kind of recover at a quick rate. So we did bounce back extremely fast, and it fell back in terms of the difference that we saw Main Street versus Wall Street, right? The S&P 500 once again setting all-time highs again today, but it doesn't always feel like we're all fully recovered, and that's because we're really not. Right? If you look at things from a GDP perspective, it's almost a V interrupted, or a square root, some people will call it, right? We saw that big snapback. We've seen a little bit of a stall more recently, as we've seen some certain areas of the economy recover while others have not, which is really important to keep in mind, right? We want to kind of take a look at in terms of what's recovered, what hasn't, and maybe what some of our future opportunities are going to look like. So rather than focusing on data that's only updated on a quarterly basis, we actually looked at slide 24 and kind of put this together using high frequency economic data, right? So things that we can chart on a much more regular basis. And as you can see, in March of last year, we saw that huge sell-off. We saw the economic activity really just kind of shut down, right? We all were locked in our homes and just kind of waiting for things to get a little bit better. So that's where we saw that initial drop. But as we started to kind of move along, and as some areas of the economy started to open up, we saw some recoveries, right? Mortgage applications and consumer spending, right? We saw that start to tick up a lot faster than everything else, and actually reach the levels that we saw in some cases in as early as May of last year, right? People were looking to move out of the cities, right? Buy bigger homes and kind of shift their lifestyle a little bit as they start to adjust and maybe plan to work from home for a lot longer. But leaving behind some areas more in the service industry were kind of what we saw on the bottom part of the page, right? Hotel occupancy, travel. So that's what we use by tracking data that's done by Waze. Seated dining, TSA travel. So are people getting on planes? And we saw that really, once again, completely shut off and start to recover a little bit after COVID started to settle down and whatnot. And then we obviously had the surge back here once again. But really what you're seeing is that stagnation here, right? We're not going to see that full growth, that full recovery from an economic perspective until we have that mass distribution of the vaccine, where we're starting to see whether it be herd immunity or those individuals where we're starting to see states and local governments start to be able to open up again. So something to keep in mind as we're kind of shifting out of that, right? Because if you think about, once again, that Main Street versus Wall Street type of feeling, we once again just look at the areas that have done really well coming out of the COVID-19 crisis, right? On the right-hand side of the page, looking at the S&P 500, kind of the components of that, nearly 40% is technology, 13% is healthcare, right? Areas that did really well and were positioned really strongly to take advantage of kind of the work from home type of environment, right? So no wonder why the S&P was able to recover a lot faster than what we've seen from the left-hand side of the page, from the economy, from an unemployment perspective, right? You're starting to see the more service type of industries dominating the larger chunk, whether it be GDP or employment status, right? Those areas that were much more affected that we looked at on the previous page. So when it feels, and people talk about, well, why does the economy feel so much more sluggish than maybe what we're seeing from a market perspective? It's because it is, right? It's a services industry versus a manufacturing one, and something to keep in mind, but also presents us with a lot of opportunities, right? We saw online retail, technology, home improvements, those areas, the total return in 2020 or since the end of 2019 to the beginning of 2020, right? Those areas that really were able to thrive in that work from home environment, but also down here, right? Those areas that had a lot of challenges that were presented from the lockdowns and from the work from home environment. So we look moving forward, having active management, having the ability to kind of pick and choose these different industries. Main concept and kind of main theory behind this slide really is just kind of thinking about, once again, right? How are we looking forward? How are we able to take advantage of some of the opportunities that the market may present ourselves, and some areas that may have been beat up a little bit more than others. So something to definitely keep in mind when we're looking forward from an equity perspective. But I think the common theme and something that we all have to remind ourselves is that volatility is normal, right? And what we're looking at here is slide 18 from the Guide to the Markets. I think one of our most popular slides, and we actually publish this in a variety of different ways and for different indices, but just reminds us that volatility is normal, it needs to be expected, but can't derail our overall long-term goals. Right, so looking at this chart, the gray bars represent the S&P 500 price return each and every year. Red dots represent our biggest peak to trough decline, or our volatility each and every year. And generally, the way I like to point this out and kind of highlight this at first is just show everybody that on the bottom part of the page, there's some sort of red dot every single year. Right now, there's going to be certain years where we have elevated levels of volatility. Right, what we saw, the flash crash in '87, the tech bubble in 2000, 2001. Our financial crisis in obviously in '08, and then in 2020 with COVID-19, where we have those really high and unusual levels of volatility or bigger sell-offs. And there's going to be years like what we saw in 2017 where there's virtually none. Right? But on average, when we kind of put the punchline up top, is that our clients should expect a peak to trough decline of right around 14% each and every year. But that's okay, because those investors who've weathered the storm, they've stayed the course. Markets have generally rewarded those investors who've stayed in the market, right? 31 out of the 41 years we've charted here, 75% of the time, the markets have ended the year positive, despite the volatility that we've seen. So Mr. and Mrs. Client, it's always important to remember and keep in mind that, yes, we should expect volatility. It is going to happen and doesn't make us feel comfortable, but we need to stay more long-term focused. And I think really when we go through this deck and kind of think about some of the different slides here, that's going to be a common theme. Right, trying to stay more long-term focused and trying to find ways to stay less emotionally invested on a day-to-day basis. But if we think of things from a fixed income perspective, we'll just kind of take a look at the Fed and the Fed funds rate, and essentially kind of what we've seen is just long-term projections for where we'll see rates moving forward versus what the market expects and what the estimates are from the Fed itself. So gray line just going to be the Fed funds rate, as we've seen that those historic levels during the financial crisis. We started recovering, we were seeing things trend upward, and then, oh, by the way, COVID-19 hit, and we had initially dropped rates back down to essentially zero. Right? In our view, we're probably in a lower for longer environment. I know we've seen a bit of an uptick in rates with the 10-year right around 1.4, 1.5 this week, but something that we expect to be more range bound and going to be lower for longer. What you're going to see is that over here, the Fed's long-term projection is that to be around 2.5%. So when we think long-term, we're thinking 5 to 6 years out, just as something to keep in mind. Right? So a lower for longer environment, something that we have to keep in mind, because our investors who've used bonds and used fixed income for a long period of time really gauged everything off of the 10-year. Right? Some of our older investors and people who are drawing income from their current accounts were used to investing in bonds back when the 10-year was providing a coupon of just north of 15%. Right? They were in essentially a Goldilocks scenario. Right? As rates fell, their bond prices appreciated. Right? They had their protection from equities. Right? Their diversification with bonds. They had that high level of coupon, the income that they were going to need, and got that price appreciation along the way. So definitely something that was really a big benefit to clients' portfolios. But as we look forward, moving from these historically low type of levels, we need to think about things a little bit differently, right? Our quote unquote safe assets, our core fixed income, maybe potentially could put us in a position to lose money later, right? Now, once again, we're still in the same camp that rates are going to be lower for longer, but what if we're wrong? And what if they're not and rates do end up backing up? Right? We need to understand what the impact is on a client's portfolio. And if we're looking at the right-hand side of the page, we see the impact of a 1% rise in interest rates. So what if we went from 1.53 with the 10-year up to 2.53? Your investors who are using your 10-year as a safe asset now are subject to about a 7.5% loss for their safe assets. Is that something that your client can weather the storm with? Is that something that they can continue to stay invested with when their safe assets have now lost them 7.5%? I would think not, right? I think that conversation now brings to the expectation that clients need to think a little bit differently, right? So what have they been doing? Right? We've seen as volatility levels have come up, we've seen clients continue to pile into fixed income. And really at a lot of places, it's been on the short-term end of the curve, right? But what do people do as they're starting to look for income, right? Our core fixed income, what we had talked about before, those that 10-year treasury that at one point was yielding us north of 15%, right? What are those investors doing who are using that for coupon before, who are using that for consistent income? Right, what we're seeing is they're starting to trend upward, right? They're starting to look in this upper right-hand quadrant of the page, looking at things like U.S. high yield, emerging market debt, maybe convertibles, which are hitting that yield bogey that they're looking for, but there's also a trade-off, right? Their bonds are now starting to look a lot more like stocks, right? Their correlation to equities, meaning they're moving in more in sync with one another, are getting closer and closer to one, right? Meaning their bonds are starting to act a lot more like equities. So the goal and kind of the conversations that we need to think about is having and using fixed income the way we did before, right, as a diversifier, but maybe thinking a little bit differently, trying to find ways to invest and kind of get something of a return up here, right, and leveraging and talking about annuities as a new asset class. We did actually just publish a new white paper that just talks about some of the benefits that variable annuities and fixed annuities do provide for clients, right, outside of their normal scope around their traditional 60-40 type of investing, right? So thinking differently moving forward is going to be so important because our environment and kind of the investable assets that we have are acting and are actually very different than what we had seen over the last 20 or so years, right? So important to kind of keep in mind that we need to think a bit differently moving forward. So if we shift gears a bit and kind of think overseas and look at an international perspective, I think there's a lot of opportunity out there. I think for domestic investors, there had been many challenges and many investors who are reluctant to look outside of the U.S. borders. And domestic equities have been really strong over the last few years, and people are hesitant to move away from that. But the opportunity that's out there is truly massive, right? And just looking at things from a valuation perspective, so how cheap they are relative to their historical averages, we're seeing that first off on the left-hand side of the page, emerging markets look extremely cheap, right? What we're seeing here, and just the easiest way to look at that is the purple dotted line in the middle of the page just represents the average levels for price to book ratios within emerging markets, right? Being below, nearly a whole standard deviation below that shows us that international, more specifically, emerging market stocks are very cheap. Right? We look at things on the right-hand side of the page, developed international markets. Once again, middle line, the middle purple dotted line in the center of the page is showing us what our historical averages are, right? Once again, just looking at international from a valuation perspective, obviously things much cheaper than what they are relative to their historical averages. So creating a large opportunity for us overseas. So we're looking at things that are cheap relative to their averages. And one other thing we want to consider is what the growth opportunity is. And if we look more specifically at emerging markets on the right-hand side of the page, we can see that the growth expectations are massive, right? If you're looking at areas like India and China, just for example, the growth of the middle class that we're seeing is really going to be what drives the economic data moving forward, right? The opportunity or those investable assets that people have are going to be put into the market as we see things continue to grow. So in the gray bars are just going to represent the percentage of the total population in 1995. So within India, about 1% of the total population. What we see in 2019, about 17% of the population. And in 2030, we see in our forecast that about 80% of the population is going to be consisting of the middle class. And if you think about the impact that the middle class has on the economic and the spending habits from a GDP perspective is really going to be something that really drives the overall economy. So we're looking at areas of the world that, in areas of the world, the stocks that are attractively valued. We're seeing those massive growth opportunities because of the growth of the middle class. So from our perspective, we see a lot of opportunity overseas. And specifically when you're using products like annuities that give you that level of protection, it gives your clients the ability to be comfortable about taking on maybe a bit more risk or assets that have been riskier in the past. But I think if we kind of start to rein things in a little bit and start to think about kind of how we relay this into a longer term picture and talk more about the emotional aspects of things, I think 74 from the guide does a great job in just highlighting why clients need advisors, right? And what it's done is that on the bottom part of the page is it's a study which is done by Dalbar, and they track all of the traditional retail mutual fund flows in and out of your client accounts, right? So your Schwab, your E-Trade, maybe a Fidelity account, just monitor the buying and selling in and out of different mutual funds. And what they found is that clients are very emotional, which is, I mean, not extremely surprising, right? We're all tied to our investments. We're tied to our nest eggs that we've saved forever for, right? When momentum continues to kind of shift upwards and things look strong, right? We're all really excited. We're positive. There's euphoria in the markets, right? Our Uber drivers are telling us about their favorite tech stock to buy, right? But when things shift the other way, right? When the fog starts to settle in and there becomes a lot more uncertainty or markets turn negative, right? We as investors start to get nervous. We start to get emotional, right? And we hit that button, or we utter the words, get me out, or hit the sell button, right? So using your advisors and using your ability to kind of build out those all-weather portfolios, now whether it's a 60-40 or a 40-60 or a 70-30, I'm sure the ones that you're putting together are much more dynamically constructed, but it allows us to be less emotionally invested on a day-to-day basis. It allows us to be more focused on the long-term aspect of things. And why that's so important is because if we look at kind of what time does for us, if we zoom out the lens a little bit, we can find that we essentially have a much better opportunity for success. And so what this slide does is just focusing on stocks in green, we look at the range of stocks going back to 1950, so a best and worst case scenario on a variety of different trailing returns. So on a 1 year basis, the best case scenario your client could have experienced was a positive 47% return, and the worst case was down 39%. It's a pretty tough pill to swallow, right? It's a pretty tall ask for our clients to be okay with the fact that possibly being down 39%. And so if we shift our lens a little bit and maybe focus on the long term a bit more, we can essentially almost eliminate our tail risk, right? So by looking at that rolling 5-year period, that same period of returns going back to 1950, right? Our best case scenario is now annualized positive 28%, and the worst case is now only down 3%. It's a very different conversation, a very different type of feel in terms of what we should expect moving forward, right? Staying invested long term really matters, right? It's more about time in the market as opposed to timing the market. And that shifts us back to a slide from our guide to retirement, which I think is a great one to kind of leverage and think about because of the velocity of how quickly things move, right? And what impact missing some of the best days of the market can actually have on our portfolios. So looking back over the last 20 years, assuming a client was fully invested in the S&P 500, they give an expected return right around 7.5%. But what would have happened if they missed just the 10 best days over that 20-year period? Right, their return is now cut more than in half, down to about 3.25% or 3 1/3%. What happens if they miss the 20 best days? Once again, over that 20-year period, your returns are essentially flat over one of the better periods that we had seen historically. And the client's next question generally tends to be, well, what are the odds that I miss the 10 best or the 20 best days over a 20-year period? And it's actually quite likely because 7 of the 10 best days occur within 2 weeks of the 10 worst days. And if we look at things a little bit more specifically, the second worst day in 2020 was March 12th. That was immediately followed by the second best day of the year. Right? So we not only have to be wise enough to sell out before these big sell-offs or these big downward trends of the market, but also when emotion is at its highest, when uncertainty is its greatest, we have to be able to push our chips back in on the table. And as we discussed on previous slides before, right, our emotions don't allow us to do that. That's why we have advisors. That's why we diversify our portfolios. And that's why we use annuities, right, to add that layer of protection to allow us to be less emotionally invested. Because we all know that we're living longer, right? For a variety of different reasons, and it's whether it be healthcare advances, we're taking better care of ourselves, but the fact is that we're living longer. But we need to manage our expectations, our ability to work longer. Because what we're looking at here is the individuals who are expecting to retire at the age of 65 or older. Nearly 70% of the population, or just north of 70% of the population, expect to work to 65 or older. But only 30% actually get there. Right? The actual median retirement age ends up being around 62 years old. So a 3-year spending gap, generally speaking, when someone is at their highest wage, highest earning levels. Right? So that's a 3-year gap in which we're not saving money and we're not contributing to the ability to have a more successful retirement. Right? So we have to think about things differently. We have to plan for living longer and maybe not working as long as we had expected to, because there are some reasons why we retire early for positive reasons. But the overwhelming majority is because of up here, right? We don't expect to have these health problems or disabilities. Maybe we don't expect changes or downsizing at our company, right? So we need to plan for that scenario in which we have enough assets to make sure we're not outliving our savings, right? Because what happens if we are starting to retire earlier and we are needing to pull money out of our retirement accounts, whether that be a pension plan or whether that be an annuity that we have, right? Really what matters is what type of environment we retire in, right? If we retain that risk, we run the risk of.
And you can see my screen, right?
I can see it.
Okay. Yeah, probably Brian had some technical issue today, but it's already great information. I mean, I already write down a couple of notes, which is great. You know, we are not in the environment anymore compared to 20 years ago. So, Brian, you still have something to share before we jump to our next chapter?
I was just wrapping up there. So
okay.
I think long story short really means really kind of circles around once again, and not to continue to reiterate the same point, but time in the market as opposed to time in the market, right? Finding ways and finding solutions that we're able to leverage to allow us to be less emotionally invested on a day-to-day basis and more focused on the long term. Once again, if there were any questions, and apologize for some of the technical difficulties that we had, whether that dropping in and out here or some of those kind of with the blips on the radar there, but feel free to pass along any questions. More than happy to answer or address any of those, whether it be on the slides that we discussed today or any that might be more relevant to some of the conversations you're having as well.
Great. Actually, I think we should invite you again, since there's quite some interruption today. Some people maybe not having enough from you. So yeah, thank you very much for joining us and bringing those insights. I think right now for the investors, emotion is the one thing people cannot really control. So at home, our kids are at home, right? So sometimes when being parents, we're very emotional. And during the investment world, it's the same thing. When the market goes down, everyone is panicking, and when the market is going great, like these days, right? Everyone is hyper. So thank you for bringing us those subjective concepts over. All right. So with that, thank you very much, Brian and Ben. Ben, you are going to still stay for a while, right?
Yeah, Brian, thank you so much. I think yeah, to reiterate that was great, and I think we'll send those slides out, Jerry. So if people want to do some one-on-one sessions with me or even Brian, let me know. I think the last two slides that he was going to show are my favorites, so maybe it's a little bit of a tickler of, hey, if you want to see
you want to share, I'm totally fine. I mean,
no, I think it's okay. I think I think what Brian was talking about, I think dollar cost averaging, just kind of talking simply, is if you look at the baby boomers, right, their number one asset's a 401k, because technically they were just blindly putting money in every week. And so people don't even know they might have $300,000 or $400,000 in their 401k. And so that's been fun. And then also the last slide was going to be just the S&P over a long term. And, you know, I think without showing Brian's screen, I'll just do it on the you know, whatever you call it. But, you know, I think when you look at Brian's last screen, it's pretty funny, because you look at the S&P like right here, and I'm not going to use red, I'll use black, but, you know, if you look at the last, call it 20, 30, 40 years, that's why Warren Buffett says it best, or get the S&P and get it long term. And so if you look at Brian's last slide, when he sends the slide out, you know, it looks more way professional, but it looks like that, right? And if you just imagine a 20-year slide, you know, long-term holds, right, reap great returns, whether it's, you know, 5 years, 10 years, 15 years, whatever it is. So I think that was the point. And I think dollar cost averaging just allows you to just slowly buy. No one can time the market. So that's what I wanted to kind of finish up. But Brian, thank you so much. You did a great job, man.
Thanks so much for having me. Appreciate it.
Thank you. All right. So because of the time restriction, so we are going to move to our next chapter.